Hello everyone and welcome back to my channel. In one of my previous videos, I shared with you a high win rate strategy that is based on retracements that has only 3 simple steps. I walked you through each step, starting with how to easily identify the bias, then moving on how to confirm that bias, and finally I explained how to find the perfect entry model along with the recommended timeframes for each step. And in this video, I'm going to show you how to take continuation trades instead of retracements. I'll break down a live trade example so you can see how to apply this strategy in real trading environment. This will provide you with a framework to trade both sides of the market, and I promise you that if you invest the time and effort into studying, practicing and backtesting this strategy, you won't need anything else. So if you are interested in that, then stick around until the end and don't forget to hit that like button and subscribe to my channel so you won't miss any upcoming videos. And let's get started. So here's the strategy that I previously shared with you. So that is based on retracements. So we are taking trades from external range liquidity to internal range liquidity. So after the price takes a swing high or a swing low and leaving a fair value gap behind, then we want to take that retracement to a fair value gap, right? Now we're going to add another line, which is basically from internal range liquidity to external range liquidity. And that's it. This is how you take trades on both sides of the market. Why? Because price moves from external range liquidity to internal and from internal to external. Price does only 2 things, guys. It will either seek for a liquidity that rests above swing highs and below swing lows, or it will seek to balance imbalances, order blocks, breakers, and mitigation blocks. Price use that to reach one of these 2 things, right? Those serves as a narrative. All right, now let's remove this. And the structure of this video is going to be as follows. I'm going to break down a trade, a live trade that I took this morning, and I'm going to show you how exactly I applied each step, right? Each step of this plan on that particular trade. So trading by example. And here is the trade. I shared that on my Twitter account if you want to go and follow me there. So here you go. And here's the trade. I took a short here and exited here. All right. And now let's start. And now let's start with the first step. So first of all, we have the bias, meaning why. Why should we go up or why should we go down? The time frames are the weekly, the daily, or the 4-hourly. We're going to use only these 3 time frames. Below these time frames, it's going to be scalping or high frequency trading. So if you can use the 1 hour as bias and maybe the 1 minute or the 30-second for entries, I don't like that. Or you can maybe use the monthly for bias. So this is swing trading. For short-term trading, we're going to use these 3 time frames. So we want to see price goes from internal range liquidity, and then we're going to target external range liquidity. Let's go to the charts and show you how that looks like. So here we have the euro against the Australian dollar chart. So as you can see here, we have a nice displacement to the downside here. This is the first thing you want to look for, a nice displacement, energetic, and you want it to leave a fair value gap behind, right? And once price retraces to that fair value gap, and as you can see that the order flow is bearish. Once price reaches to that fair value gap, and here is the fair value gap, right? From here to here, you want to target external range liquidity. So this is the bias. Once price reaches a fair value gap, internal range liquidity, the next thing is you want to target external range liquidity, right? So when you are here, you have the idea of going short, but you don't go to the 5 minute and take trades. No. Now you're going to use the second phase or the second step, which is the confirmation or the narrative. So how price should go to that external range liquidity. All right, so now we have determined our bias, and we have also tapped into this daily order block. So this is another confluence. All right, now we move on to the second step, which is the confirmation, and we're going to use the 4 hour, 1 hour, and 15 minute. if my bias is on the daily, then I like to use the 1 hour for confirmation, right? Just match this time frames: weekly 4 hour, daily 1 hour, 4 hour 15 minutes. So this is the how we're going to reset external arranged liquidity. And the first step is we want to see a market structure shift, and we want to see sweep first. So before that market structure shift, before the displacement to the downside, in our example, we want to see a sweep. So a recent swing high get swept. So this creates high resistance liquidity environment, meaning traders that want to go short has been stopped, right? Or we want to see an SMT divergence. So if we didn't see that sweep, we want to see an SMT divergence with another pair. Easy as that. So if we go to here, price tapped into that order block, and we still on that internal arranged liquidity, and we want to target that external arranged liquidity, right? And now we want to see a nice displacement to the downside. Energetic displacement. Is this energetic displacement? No, this is not an energetic displacement. I have created a video about what is and how does a perfect market structure shift look like. So please go check it out. That video is full of gems. So as you can see here, we have a displacement and we have a sweep first. So as you can see, price swept this swing high first, and it left a fair value gap. All right, so displacement, taking this swing right here, breaking this swing and this swing, sweep, and then a fair value gap left. And also I have included a market maker X model. Basically we want to target consolidations. So consolidations looks like this. We want to see this structure to target. Why? Because this structure represents low resistance liquidity, right? So below each consolidation, you will find low resistance liquidity, right? And you can see here that we have that here. We have the original consolidation. We have the first accumulation of longs, the second accumulation of longs, and then smart money reversal. On 15 minutes, it looks even better. So here we go. Consolidation, and then accumulation, and then another accumulation. All right? So let's go back to the 1 hour. And as you can see here, that we have satisfied the second step, which is the confirmation. So now we have the bias. We confirmed that bias. And now what has left is the execution. The execution, I'm going to use the 5-minute time frame. So the first thing on the execution, we have the time. The London kill zone, 2 a.m. to 5 a.m. New York time, and the New York kill zone, which is 8 a.m. to 12 p.m. New York local time. All right, so make sure you are trading on those times, right, for high probability trading. The next thing is we want to see a market structure shift from a period array on that confirmation time frame, and of course we want to see sweep first or SMT divergence. What I mean is when you see this displacement to the downside, this displacement will leave PD arrays. In our case, it has left this order block, right? These two consecutive candles, up close candles are order blocks, and we also have left this fair value gap. How do you determine which one? All you have to do is when price reaches to the first PD array, which is this fair value gap right here, what you want to do is to go to the lower time frames and see if price gave us any signals to go down, right? So for example, we can see here that we have a displacement to the downside. Then you're no longer going to wait for price to reach to that period, that order block, right? And we want to see again market structure shift, and we have that here, right? So we have a sweep first, sweep on recent swing high, displacement to the downside, breaking this swing and leaving PD arrays. The PD arrays that has been left, we have this breaker block. These 3 consecutive candles are a breaker block. Why we choose 3? Why didn't we choose only this? Because if we go to the lower time, if we go to the higher time frame, like the 15-minute, this will be a single candle. And here we go, right? This is why we don't choose the last one. We are not supply and demand, all right? So we have also this order block right here, and we have also this fair value gap. You can enter from any of these PDR race, I prefer to enter on the 50%. All right, so all you have to do now is to enter on the pullback. And now, of course, let's add the element of time to our trade. So if we put a vertical line on midnight, on the midnight open, which is the true day open, we want to see price trace above or accumulates shorts above that midnight open, right? And we have that here. If I don't see this move right here, if I'm anticipating a bearish day, all right, and we have all these steps aligned with each other, and I don't see this move, I don't see price trades above the midnight open, then I have no trade, all right? So this is very crucial, guys. And now all you have to do is to take the trade, and I like to aim for 2R, right? So in and out in a matter of minutes. You can also leave runners. You can maybe take 75% of your position and target all this consolidation right here, which is the original consolidation. Price always tends to attack this original consolidation. This is where the market maker sell model ends, when price reaches for this original consolidation. All right, so I believe this is the simplest strategy out there. If you put the work in, if you journal your trades, collect examples, study them, all right, I believe that you will be profitable. Of course, you're going to have to work on your psychology and risk management, and you are good to go. So I believe we have come to the end of this video. If you have any questions, please DM me on my Twitter account or leave a comment down below. I'll answer you as soon as I can. Happy trading and good luck.